The Property Bulletin by London Property, the home of super prime.
Charlie Mullins, the founder of Pimlico Plumbers and Britain's wealthiest plumber, is selling his £12 million London penthouse and leaving the UK, over concerns about potential tax hikes under a future Labour government. Mullins, who sold his business for £145 million in 2021, plans to divest all his UK assets, shifting his investments to Spain and Dubai. He's already hired an agent to sell his luxury apartment, which features a bar and is located next to Sir Tom Jones's property. He intends to completely sever his financial ties with the UK, saying, "I'll have no investments here, no bank account here, it's all in the process now." Mullins' decision is influenced by fears of increased taxes for the wealthy, particularly inheritance tax. He specifically mentioned the concern of losing £6 million due to the tax burden. This comes amid speculation of tighter financial measures in Chancellor Rachel Reeves's upcoming budget, with Labour leader Sir Keir Starmer indicating that the richest will shoulder the brunt of these charges. As a former Tory supporter who now backs Reform UK, Mullins joins a growing number of wealthy Britons seeking to relocate abroad, driven by fears of tax hikes. Despite his departure, Mullins plans to launch a new business in the UK. Once his non-compete clause with Pimlico Plumbers expires, he will introduce WeFix, a plumbing and handyman service branded as the Harrods of the handyman world. The company will be run by his son Scott and grandson Ashley, though Mullins himself will not be in the payroll or hold ownership, as the business is funded through a family trust. Mullins also remains critical of Labour's proposed workers' rights reforms, warning that default flexible working arrangements and full employment rights from day one could deter businesses from hiring. WeFix will take a firm stance against unionisation, remote working or a 4-day week, instead incentivising employees with a profit-sharing scheme after 1 year of service. Charlie Mullins' rise from a childhood of poverty in London's Elephant and Castle to a self-made millionaire has made him one of Britain's most prominent entrepreneurs. He founded Pimlico Plumbers in 1979 and grew it into a leading business before selling it in 2021. The latest figures from HMRC show that homebuyers paid over £1 billion in stamp duty in June. Coventry Building Society has called for reforms to stamp duty in the upcoming October budget. Currently, home buyers in England and Northern Ireland must pay stamp duty if their property exceeds £250,000. However, from March 2025, this threshold will drop to £125,000, raising the tax bill on an average-priced home from £2,768 to £5,268. First-time buyers benefit from a higher threshold, paying stamp duty only if their home exceeds £425,000, but this is also set to drop to £300,000 in 2025. There is an additional 3% surcharge for anyone purchasing a second property. Jonathan Stinton, head of mortgage relations at Coventry Building Society, emphasised the financial pressure this places on home buyers. He highlighted how stamp duty bills, which can total thousands of pounds, often force buyers to borrow more. He argued that with the threshold halving in 2025, the Treasury is set to benefit even more at the expense of buyers. Stinton suggests that the October budget could be an opportunity to adjust stamp duty rates and ease the burden on buyers, pointing to the successful stamp duty holiday in 2020 and 2021 as evidence that such measures don't have to drastically impact tax revenues. Instead, home buyers could use the saved funds to invest in home improvements, ultimately benefiting the broader economy through increased spending and VAT contributions. Following the release of recent statistics from Rightmove, which reveal that the proportion of former rental properties entering the sales market has reached its highest level on record, the National Residential Landlords Association, NRLA, has responded with serious concerns about the future of the buy-to-let sector. Chris Norris, Policy Director for the NRLA, commented, "Today's data will be a serious concern for all those renters struggling to find somewhere to call home. With demand already massively outstripping supply, Rightmove suggests the situation is set to get worse. Every rental home that is sold simply exacerbates the imbalance between supply and demand. While some of these properties will inevitably end up in the owner-occupied market, that will be of little comfort to households struggling to access quality housing. What we need is a housing strategy that recognises the need for more of every type of property, including high-quality homes for private rent. That's why the budget needs to announce pro-growth tax plans to meet the needs of renters across the country." According to the data published today, Rightmove reports the highest ever proportion of former rental properties entering the sales market, which may be partly due to a potential increase in capital gains tax, anticipated in the autumn statement on 30th of October. The key findings include 18% of properties now for sale were previously on the rental market, compared to just 8% in 2010. London is the hotspot with nearly a third, 29% of homes for sale previously being rental properties, followed by Scotland 19% and the North East 19%. The 5-year average for homes moving from rental to sales in Great Britain is 14%, showing this isn't an overnight trend. The number of new properties entering the sales market is 14% higher than last year. The NRLA is calling for a housing policy that not only addresses the immediate imbalance, but also ensures a long-term supply of rental homes. Rising house prices in the first half of 2024 have pushed the total value of the UK's property equity to a record £5.7 trillion, according to analysis by the Equity Release Council. This figure surpasses the previous high of £5.6 trillion from mid-2022, when the housing market was driven by pent-up demand following the pandemic. Total UK mortgage debt currently stands at £1.6 trillion, compared to an overall property market value of £7.3 trillion. The data reveals that this results in an average loan-to-value LTV ratio of just 22.2%, meaning 77.8% of the housing market is effectively owned outright in equity or cash. Over the past decade, the average LTV has fallen from 28.9%, indicating that for every £10,000 of property owned, 7,720 is equity-backed, with only a minor share covered by mortgages. Jim Boyd, CEO of the Equity Release Council, commented, "While we haven't seen double-digit growth in house prices this year, the property market has started to recover, pushing the total value of unmortgaged residential property in the UK to over £5.7 trillion. Much of this wealth is held by the older generation, and our findings make it clear that the prospects for a comfortable retirement rest on firmer foundations if you own your home and incorporate property wealth into your financial planning." Boyd also highlighted the challenges facing both households and the government in terms of spare funds, addressing the importance of helping older homeowners consider how the £3.4 trillion worth of property wealth can support their later life finances. Though property wealth is most concentrated in the south of England, the Equity Release Council notes that every region in the UK has significant reserves of housing wealth among its older population. The Council's analysis shows that homeowners over the age of 55 hold property wealth worth more than 22 times the £152 billion the government is expected to spend on pensioner benefits in 2024-25, according to the Office for Budget Responsibility. Boyd urged policymakers to look beyond pensions as a means of improving retirement incomes. "We urge the new government to set out its vision for property wealth and later life funding. A thriving later life mortgage market can help improve retirement incomes and stimulate the economy." HMRC has released updated guidance explaining how property owners can apply for a refund of higher rate stamp duty land tax, SDLT, when selling additional properties, offering clarity on the process. Property owners who've paid the higher rates of SDLT on additional properties may be eligible for a refund if they sell what was previously their main home. This applies to both the main buyer of the property and accountants acting on their behalf. To qualify for a refund, the previous main home must have been sold within 3 years of purchasing the new property, unless exceptional circumstances apply. If the previous main home was sold on or after October 29, 2018, the refund request must be submitted by the later of 12 months after the sale date or 12 months after the filing date of the SDLT return for the new main home. Even if the previous home took longer than 3 years to sell, a refund is still possible under certain conditions. These include cases where the new home was purchased on or after January 1, 2017, exceptional circumstances prevented the sale, or the previous home has since been sold. HMRC outlines that standard property transaction delays, such as difficulties in finding a buyer, delays in agreeing terms, or breakdowns in the property chain, are not considered exceptional circumstances. However, if the previous home was sold without further delay once the exceptional circumstances ended, the taxpayer may still qualify for a refund. To apply for the refund, taxpayers must provide HMRC with proof of eligibility, including the amount to be refunded and an explanation of why the previous home was not sold within the 3-year limit. Applications can be submitted online or via Form SDLT 16, which is available on the Government Gateway portal. When submitting the claim, details about the property that attracted the higher SDLT rates are required, such as the purchase date and the SDLT unique transaction reference number. This 11-character code can be found on the SDLT 5 certificate, which is sent by HMRC once the tax return is processed and the tax has been paid. Accountants and tax agents acting on behalf of clients must obtain written consent from their client before making the refund claim. With this guidance, HMRC aims to streamline the process for taxpayers and their representatives, ensuring refunds are claimed efficiently.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.